Yeah, we think valuations look reasonable. They look very cheap versus interest rates, but fair value against a long-term average. However, we see a polarisation in the market between those companies with the most defensive earnings streams, the most certain earnings streams. Those sorts of companies are trading at quite a premium, whereas the market is pricing a discount into any stock with a little bit of risk. So it's presenting some opportunities. We think company earnings are starting to look a little bit better for the Australian market after 3 difficult years. Resources have been a real headwind on the Australian market earnings, but because resources are a much smaller component and earnings have fallen so much, they're providing a much smaller headwind. And then we continue to see opportunities for those stocks benefiting from a low Aussie dollar. That's not only stocks which are operating offshore, but it's also exporters, tourism companies, education businesses and the like. So there's some pockets of growth in the market. The neutral style is more an outcome of our process. So our process is focused on buying good quality stocks at attractive valuations. What that means in practice is finding improving quality companies where the market has not yet recognised those quality characteristics, or it could be derated quality companies where the market's starting to question the quality of that particular business. Or the final scenario is where markets underestimating the sustainability of the earnings growth on offer by a good quality company. So by having those 3 areas in which to focus on, drives a fair bit of consistency in the outcome for our investors. Ultimately, the investors that benefit from our portfolio are those that are looking for active management, looking to find a stock picker who can deliver outperformance but in quite a consistent manner. So 2015 was a flat year, but there was quite a difference between the top 20 stocks which really struggled. That was your major banks, your major resources, your major energy companies, food retailers. So a difficult period for those top 20. But outside of that, there were some stocks doing particularly well, particularly those stocks which could pick up some of those growth areas, benefiting from the low Aussie dollar, service industries, some of those segments of the economy that are growing. So we are seeing those opportunities continue to emerge. But in addition, looking into 2016, given the volatility, it is a bit of a time to get a little bit more contrarian and to find some of those good quality companies which have been derated and trading at multi-year lows. So when we think about the positioning, we really think about our 3 main areas. So we think about those derated quality companies, and we're seeing a lot of opportunities there given the market volatility. We've bought into Woolworths, major banks present some opportunities, so some big blue chips trading at multi-year lows. Then we think about improving quality, and there's some segments of the market which have been struggling, exposed to the commodity cycle, such as Qube, which is a major logistics company, or ALS, which is a major lab business across the globe. And both of those types of businesses have been improving their core business, and focused on improving returns going forward. So presenting some opportunities. The final area is just those areas with sustainable growth. Continues to be stocks benefiting from the low Aussie dollar, and continues to be some stocks which have got some structural growth associated with a very strong market position, including software businesses such as Iress, which really dominates in the financial software part of the market. Firstly, we offer active management. I think it is a sort of market where you want a stock picker who can tailor the portfolio to best suit the market conditions, and that'll ultimately deliver the outperformance. Secondly, our focus on buying quality stocks gives the portfolio some endurance and some consistency in the outcomes we deliver for clients. And thirdly, I think given the market volatility, we're seeing opportunities, we're seeing some valuations on offer that are quite attractive, and some of the better valuations we've seen for a number of years.